Greetings, guys and gals. Welcome back here. JJ from School of Trade. Happy hump day to you. We're going to the bottom half of the week. Happy summertime trading to everybody out there. Hope you guys are having a great week so far. It's been a very productive week so far in our live trade room. And today I want to talk a little bit about a pattern that we saw on gold futures this morning. Now remember, gold is one of those markets that has a negative correlation to the dollar. I give you dollars, you give me gold. Okay, it's a shelter market, so when people feel like their paper currency is losing value, they'll buy gold. That's why gold and the dollar index are oftentimes used in, well, we use them all the time in our live trade room because we know when the dollar is rising, people are confident in the USD and they're most likely selling their gold now and gold will fall. We got some great opportunities trading gold this morning. Before I talk about the trades that we took today, though, I want to remind you, if you want to see all of our trading activity, join the free trial or come out and see me every day as an advanced member. Now, our advanced members, they're in the live trade room with me every morning. We do a recap at the end of every trading session. I record it. I upload it into the advanced course. That way, everybody who could be here or couldn't be here with us today in the trade room can learn right along with us. And again, I post that same thing, though, in the free trial. That way you can see as a trial member, right, what it's like to be a part of our live trade room. Join the free trial. I'm going to show you a lot about my methodology. I'm going to invite you to come out and see me for our trade room open house every afternoon. Come out and see me for that. All right, enough of that. Log into the free trial, join the trial. You'll see what I'm talking about from there. Let's take a look at gold. Now, I'm going to start here on this chart right at 8 o'clock, right where we began our morning this morning. Now, I'm here in Los Angeles. I trade the U.S. morning session. We open up our live trade room Monday through Friday at 8 a.m. Eastern time. This morning was no different. We trade actively from 8 a.m. until 12 p.m., and then we'll trade whatever we get in the afternoon session, right? Afternoons, especially in the summertime, are a little bit fewer and far between. So here we are. We're going to begin the day this morning at 8 o'clock in the morning, 8 a.m. Eastern time. We know that gold is trading inside the range from yesterday. Now, I want to show you two very important price levels, and if you're a new trader out there, probably a good idea to write this down. The previous high of day and the previous low of day. Now, I want to be more specific. This is using the electronic trading hours, okay? We're not using the regular trading hours. Okay, the regular trading hours on gold would, 8:20 to 2 o'clock, right? That's when the pits open for gold futures. I'm going to be using the ETH, the electronic trading hours. Basically, it's open about 23 hours and 15 minutes. So it's basically 12 a.m. to 12 a.m. It's about 45 minutes when electronically it's closed. The bottom line is, though, this previous high of day should be the highest point from yesterday. And this previous low of day should be the lowest point from yesterday, whether it was inside or outside of the regular trading hours. Now, the previous high and previous low of day, we have a setup, a trade setup, which I call the inside out. Okay, it's called the inside out trade setup. It's one of the 10 or so setups that we teach all of our members every day in our trade room. This is a very simple setup, and this is why I wanted to introduce this to you guys here today, because if you're a brand new trader, this setup specifically has been making me money for over 10 years now. It continues to be one of the easiest to learn, one of the easiest to earn with, and we see these, well, at least once a day on pretty much every market we trade. So you're never going to go poor with this setup in your arsenal. And of course, I'll teach you guys everything about it, how to enter, how to exit, management, all that fun stuff as a member. So there's two scenarios here. The first thing we see is that we are inside the range from yesterday. If I'm inside the range from yesterday, think about what Market Profile says. Anybody out there read that book, Mind Over Markets, right, by Dalton? Anybody know who Peter Stettlemyer is? He's the guy who found this market profile theory. He was a trader on the bond pit of the CBOT exchange, now the CME group. And market profile theory is something we talk about in our beginner course. If you're not familiar with market profile theory, Now, I'm not talking about all the fancy marketed indicators out there for market profile, okay? Do not be confused. Market profile theory is very different than what you see pushed and peddled these days on YouTube, right? Trying to make it look like a better mousetrap for market profile. I'm not a big fan of those peddlers of the fancy-dancy market profile indicators, but I do believe, though, very highly in market profile theory. And that says that if I am, let's pretend the previous high of day is the value area high. Okay, so instead of the previous high of day, we'll call this the value area high. What does market profile theory tell me if we open up this morning at 8 o'clock and we are below the value area high? Market profile theory tells me that if we are within the value area bracket, the market personality is thought to be in balance, right? In other words, the value area high, and we'll say the value area low down at the bottom. Okay, so I'm going to use these just like I'm going to use the value area high and the value area low. I'm going to interchange it with the previous high of day and previous low of day. Same stuff, same theory. And if we're within that range, right? If I'm within that range right here, now I know the market is in balance. What does imbalance mean? A good example of imbalance would be if you were, let's talk about buying a brand new BMW. If I'm the owner of a car lot and I want to sell all the BMWs on my car lot, what am I going to do? I'm going to drop the prices. What's going to happen? You're going to show up and you might just buy 2 BMWs, right? If I drop the prices on my sticker for the new BMW and you find it attractive, you're going to buy. And other people are going to buy. And more people are going to buy. And I'm going to see that and I'm going to decide to increase the price, right? So in other words, the value area bracket, it basically illustrates, it's a visual of supply and demand, right? It defines the value. So we know that the value, this is where the buyers and sellers agreed on price. Back to that car lot example, if I increased my prices on these BMW automobiles and nobody showed up, well, that price becomes the value area high. If I decrease my prices and I sell all of the cars, now that price is my value area low. Okay, so think about the value area high. That's a $60,000 price tag on a brand new BMW. The value area low, that's a $30,000 price tag on that same BMW. I'm going to sell a ton of them at $30K. Probably not going to sell many at all at $60K. But the bottom line is that that's what defines the value area bracket. Now, let's kick it up one more notch. I open up today inside the range. What does that tell me? The market's in balance. The market being in balance means that nothing has changed from one day to the next. So I can assume if I'm trading inside of this range, guys, this is very important. I'm going to assume the same participants were here yesterday. Because remember, what's going to happen is guys and gals will enter the market, whether they're speculators, hedgers, proprietary traders, they're working for a big firm. Imagine yourself being given a job by your boss. And your boss says, Joe, I want you to buy gold at $12.44. You buy as much of it as you can because that's what our business needs to make money. Whether they're hedging gold, whether they are physically buying gold looking for a delivery, it doesn't matter. It doesn't matter why they're buying. But in a lot of situations, these psychological levels mean a lot to traders. Whether their boss tells them, you get in there and you buy as much at $12.44 as you can possibly get your hands on. Or we have a specific Fibonacci ratio or a value area that's telling other people to get involved at this location. Just like I'm going to project where I'm going to look to buy, other traders also know that they wanted to buy somewhere in here too. So if we end up inside of this range, that tells me that usually the same people are trading today as they were yesterday. And people are creatures of habit. Human beings like to do the same thing over and over again. So what does that mean? If I'm trading inside the range, I should expect to see the same trading range as we saw yesterday. Now, let's kick it up one more notch. Let's go back to the BMW dealership example. Let's say now that my price tag of the BMW that was acceptable was $60,000. At the low end, right, it was $30,000, okay, for a brand new car. And nobody wanted to buy it at $60,000, right? Nobody wanted to buy this automobile at 60 grand. Aha, but I got something for you. It's a hybrid, right? It flies. It's the first ever flying BMW. Woohoo! That sounds great. Now what happens? Now you know what's going to happen. Every person that is maybe doesn't believe you, every person that wishes they could skip that traffic out front of my house, right? Every person that wishes they could have a flying BMW says, boy, $60,000 for a flying car? That's a bargain. I'm going to go pick up a car. And so sure enough, price explodes and goes higher. What happened? An external stimulus happened. What was the external stimulus? I put a banner right on the highway saying, come get your brand new flying BMW. Okay? You drive by the billboard, you think to yourself, hey, self, I'd love to get a flying car. I would buy it for 60 grand. Absolutely. So you go to the BMW dealership and you buy that car for 60K. Now what happens? You take the car home, you begin tinkering with it, and all of a sudden you realize, this doesn't fly. This is a hover car. What, just hovers on the ground? This thing doesn't fly. Nah. I'm going to talk to my buddies who bought one too, but I don't think I see value anymore in this. You know, I liked the idea of a $60,000 flying car. I bought it. I took it home. I'm just not seeing value. I don't think it's worth it. It's not really a flying, whatever the scenario, all right? Maybe you don't like the floor mats. What happens is now everybody that goes up and buys that brand new car but ends up returning it, why? Because they don't see value. They buy the car for 60K, they take it home, they go for their first test fly, and they go, this isn't worth 60 grand. Take it back to the dealership. Now what happens is what? The price must fall. Because now when you bring back your new somewhat flying BMW, I now have to make a big decision. I can't keep charging $60,000 for these cars. Most people are not seeing value for it. I couldn't get 60 grand for it without it flying. Now the value comes way down. And this is the basis of market profile theory. This is the basis of how I use our inside-out setup. So how do we apply this to day trading, right? The flying car got price going higher. Once we didn't see any value in that flying car, right, the price comes right back down, right? Makes sense to me. How am I going to make money on this trading gold? This isn't a flying BMW. Well, now think about what happens. Something external happens. What could it have been? A news event, a political statement, unrest in the Middle East. Who knows? Who cares? Something happens out there. It's an external stimulus, and that something pushes gold through the highs. You read an article about the fact that we're printing more money and you think the gold's be worth more, so you buy, right? Somebody else comes in and buys again as well, and price jumps. Just like that flying car, if those buyers don't continue to hold this up and this collapses, you know what that means. That means that the buyers, again, the buyers who bought the flying car, now it's the buyers who bought gold, believing there was value in higher prices. Now those buyers, well, they're not as confident anymore. And as soon as this price slips back below that previous high of day, that tells me now, first of all, the buyers have failed. That tells me that we do not see value in higher prices for whatever reason. I don't care why, right? I don't need to know why. I need to know when and where. And watch what happens here on gold, because what's going to happen is we're going to break out to new highs. We're going to collapse back in. Ever heard of the 80% rule? This is one of them. The 80% rule says when I get above and I close below, there's an 80% chance I'm going all the way back to the opposite side of the range. Remember, we have the same traders inside this range as we had yesterday. And those traders saw value all the way as low as that 1240.8. So the reality is we go up, If price keeps going, then we know the value is there and we'll keep buying pullbacks, right? You might be thinking that right now. Well, Joe, what happens if the price keeps going? Then what? Well, that means the buyers, like the flying car, the buyers see value and they'll keep buying and will keep rising. But at the same time, if they fail just as fast as they broke out, we are all over that now for a short. Let's walk it forward and I'll show you exactly how we took the trade this morning. The first thing happens is we tell everybody in the room, because remember, my trade room is ultimately for shadow trading, right? Everything we do is so that a new student can come in and make money the very first time they trade with me. My job is to make sure you can learn a little bit every day and you can earn a little bit every day. And we do a very good job with that in our trade room. So this morning, the first thing we said was, guys, we are inside the range. We're trading sideways. But members, if you were listening this morning, and I know many of you were, remember this morning we said, be ready for one of two things. A, I'm going to buy the lows of the range, right? We didn't get to the highs, right? That's close, but no cigar, and close does not count. Okay, close only counts in horseshoes and hand grenades. Doesn't count in trading. Scenario 1 was to buy the lows. Scenario 2 was to wait for price to go through. If it kept going, we'd buy pullbacks. If it failed, we'd sell the highs. That was the plan this morning as of 8 a.m. Eastern time. We had to wait for it. It didn't happen right away. There was our breakout. Once we see price now has broken out above the range, now the ears perk up. Now everybody in the trade room knows something's coming. Something's coming, and it's coming now. If we keep going higher, I'm going to buy that pullback because clearly the value is there. The buyers have spoken. But if we don't, if we collapse, I'm going to sell this thing short. I'm going to take it all the way down to the lows. Now, we actually found a trend line here, and that trend line became the profit target on this short trade. Okay, and watch what happens. You'll see for yourself. We get a very easy short here off the highs. It took a little bit of time to drop. But as you're going to see right now, though, well, of course, this is at 2 o'clock right now. We're getting some news events here. But this is going to bounce here. Yeah, you'll see. This, of course, is the bounce from the FOMC meeting minutes coming out right now. But as of 10 minutes ago, again, you can see there's that trend line where we're talking about mission accomplished. Mission accomplished. We use the value area bracket, right? The theory behind market profile applied to the previous high of day and the previous low of day. You want to see where the trades actually came in? Here's where we got the trades to take today. Here's the same market, just a different time frame. This is a range chart. There's my previous high of day right there. Right? Remember, that's the previous high of day, value area high, as we talked about earlier. There's my previous high of day. We go up. We get a nice little gift there. We get divergence at the highs. And this, of course, is what I call my two-step pattern, right? It's a simple bounce pattern. You get your entry number 1, entry number 2, and entry number 3. Members with me this morning got in at the first entry. If they missed the first one, they got their second entry and their third entry. It didn't matter whether you took the first, the second, or the third. Everybody knew where the profit target was. And if you took that trade with me this morning, you made over $1,000 per contract. That's $1,000 for every $2,500 you have in your account. One contract, $2,500 needed in your account. That made you $1,000 per contract this morning. And again, this is not magic. It's understanding the market's personality. It's understanding market profile theory. And as always, we put together this plan well ahead of time. Right? This wasn't something that we had to react to immediately. We were waiting for this a mile in advance. Half the battle is being prepared properly every morning, and that's exactly what we did this morning. Every morning at 8 o'clock in the morning, we do a detailed prep. We plan our trades so we can then trade our plan. And today, just made some great income trading crude, euro, gold, and Russell. The same thing happened to the Russell today. Check out the Russell. Here's the same thing. Same thing happened to the Russell today. Same exact pattern. Guys, don't take my word for it. Join the trial. Check out our trading methodology. Send me an email. Call the office. You're invited to come out and join me in today's open house. And don't forget about that market profile theory and the value area high, value area low theory applied to the previous high of day and previous low of day. If I can help with anything else, guys, you know where to reach me. I'm JJ at School of Trade. Follow the blog, join the trial. Same time, same place next time. We'll see you guys tomorrow. Adios, amigos. Bye-bye for now.